How many parents have a 529 plan but have never asked these four questions? What happens if the market drops 30% the year my child turns 17? What happens if my child earns a full scholarship? What happens if my child decides not to go to college at all? What happens to the college fund if I die before my child graduates? If you have a 529 and you have not answered those questions, this video is for you. Today, we are going to compare the 529 plan and IBC policy side by side on every scenario that matters to a parent who wants to do this right. And by the end, you will understand exactly why a properly structured IBC policy does everything the 529 does and 5 things the 529 cannot do. The 529 is a legitimate tool with real advantages. Let me walk through exactly how it works. You fund it with after-tax dollars, no federal income deduction. Some states offer a state deduction, which is one of the 529's genuine advantages. Inside the account, your money grows tax deferred, and you use it for qualified education expenses, tuition, fees, books, room and board at accredited institution. The withdrawals are income tax-free. That is the core benefit, tax-free growth for education. But here is the fine print. The account is invested in mutual funds. It is fully exposed to the market. Whatever the market gives you or takes away is what you have when your child needs it. If you use the money for anything other than qualified expenses, the earnings portion is hit with ordinary income tax plus a 10% penalty. The money is effectively locked to education. And when you file for financial aid, the 529 is counted as a parental asset, an asset at up to 5.64% per year toward your expected family contribution of the FAFSA. Finally, if you die before your child finishes college, your heirs receive the account balance. There is no additional death benefit. There is no multiplier. They get what the market left. Now, let me show you the 3 structural problems with the 529 that no amount of good performance can fix. Problem 1, market risk in year 17. If you open a 529 when your child is born, you have 18 years to build that account, but you do not get to choose when you need the money. A 30% market drop the year your child turns 17 permanently reduces your college fund by 30%. You cannot wait it out. You can no longer work to. The tuition bills do not care that the market is doing. For an IBC policy, the cash value earns a guarantee rate set in your contract. A market crash has zero effect, none. Problem 2, the use restriction trap. If your child earns a full scholarship, great news. But now you have a 529 you cannot use without paying income tax plus a 10% penalty on earnings. If your child decides not to go to college, same problem. If they attend a non-qualifying institutions, same problem. An IBC policy loan can be used for anything. If your child gets a scholarship, the money stays in your policy and keeps compounding. No penalty, no tax. Problem 3, the FAFSA disadvantage. A parent-owned 529 is counted as a parental asset, an asset toward your expected family contribution. It can reduce your child's financial aid eligibility by up to 5.64% of the account value per year. Life insurance cash value is specifically excluded from FAFSA calculations. It does not reduce your child's financial aid eligibility by a single dollar. Let me show you how a properly structured IBC policy solves every one of those problems and adds 3 protection the 529 cannot provide. Solution 1, zero market risk. The cash value of an IBC policy grows at a guarantee rate, set the day you sign the contract. The market crash in year 17 is completely irrelevant to your policy's cash value, and you know exactly what you will have. No surprises. Solution 2, no use restriction. When you need the money, you take a policy loan. The loan can pay for tuition, books, housing, a gap year abroad, a car, and a down payment on a house. If your child earns a full scholarship, the money stays in your policy and keeps growing. The policy does not care what you did not borrow. Solution 3, FAFSA excluded. Life insurance cash value does not appear on the FAFSA. It is legally excluded. Your child financial aid package is completely unaffected by your policy's cash value. Now, here are 3 things the 529 simply cannot do. Benefit 4, death benefit protection. If you die before your child finishes college, the death benefit is paid income tax-free to your beneficiaries, typically within days. Your child's education is fully funded, even if you are not here to fund it. The 529 has no equivalent. Benefit 5, the policy continues after college. When tuition is paid and the diploma is on the wall, the 529 is done. Your IBC policy is not. The cash value keeps growing. You keep borrowing against it for real estate business, retirement income. It is a lifetime financial system that happens to fund college along the way. Benefit 6, no 529 style contribution limits. The only limit on your IBC contributions is the modified endowment contract threshold. For a high earner funding a properly designed policy over 15 years, the threshold is typically far above any 529 contribution limit. Let me walk you through 6 real scenarios so you can see exactly how each vehicle performs. Market crash at year 17, 529 drops with the market. IBC policy, zero impact. Child earns a full scholarship. 529 earnings are penalized if withdrawn for other purposes. IBC policy, money stays and compounds, no penalty. Child decide not to go to college. Same 529 problem. IBC policy loan used for anything, no restriction. Financial aid, 529 counted on FAFSA, reduce eligibility. IBC cash value excluded, no reduction. Parent dies before graduation. 529 passes the account balance, market dependent. IBC, income tax-free death benefit paid. College fully funded. After college is done, 529 is depleted and retired. IBC policy continues growing your banking system for life. The 529 has one job. The IBC policy does that job and 5 others.
I want to share a story that illustrates something we see more and more. A client came to us in her late 30s. She had 2 children, ages 7 and 4. She had 529 plans for both, and she was nervous. Not about college, but about a market crash and what it would do to those accounts. We helped her structure an IBC policy sized to fund both children's education through policy loans. She made her premium payments. Her cash value grew at her guaranteed rate. The market did not matter. Her eldest started college 11 years later. She took a policy loan. Tuition was paid. Her cash value kept growing while the loan was outstanding. When her second child started 3 years after that, same process. Here's what happened when the second child graduated. She still had the policy, a policy that had been growing for 17 years, one that she then used to fund a real estate investment and repaid and borrowed against again. Her eldest recently called us. His daughter, her grandchild, is 3 years old. He asked if he could start a policy on himself to do the same thing on his daughter that his mother did for him. That is what a lifetime financial system looks like. The 529 is done when college is done. The IBC policy is just getting started.
The 529 is a reasonable tool for a specific, narrow purpose. But if you are a high earner who wants your college saving to also provide guaranteed growth, no market risk, FAFSA protection, death benefit coverage, and a financial system that outlasts the tuition bills, the IBC policy is not just an alternative. It is a better fit. If you want to go deeper on how the policy loan mechanism works, including how your cash keeps growing while your tuition loan is outstanding, download our free guide, Policy Loans, the one financial move that lets your money work in two places at once. The link is in the description below. And if you want to understand what happened to your plan, if you are not here to execute it, download What Happens to Your Money If You Die Tomorrow. It covers exactly why the death benefit is the most unappreciated part of the conversation. If you are between the ages of 30 and 55 with a gross family income of $150,000 or more, visit infinitebankingsimplified.com to book your complimentary strategy call. We will show you exactly how to size a policy for your child's education timeline and for everything that comes after. Every dollar you spend passes through a bank. Make sure it is yours.